Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what is going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics, looking for potential investment opportunities and sharing the opportunities with everyone in the community. We do have a special going on. Special is the coupon code that you type in to get savings on the monthly and yearly memberships. The monthly membership is 50% off the first month only, and the yearly membership is a larger discount. It's 4 times as large for further savings if you want to sign up for a year. Coming down, we got Wolf. Use your salary to invest in passive income until your passive income replaces your salary. Forget a better paying job with longer hours in a corner office. The goal is freedom, not bigger handcuffs. That's exactly what I did. I saved ever since I started working. I would save away and invest everything that was above and beyond my very low living expenses. I also did that because I know I wanted to have kids later on. So when I was in my early 20s and mid and late 20s, I just saved all the excess income that I had and invested all of it. I invested a lot of it in 401ks. There's some stuff that I saved outside of 401ks to kind of have a balance between access to money, health savings accounts. When they became available, I was using those. So I did everything the quote right way, I would say, and I didn't do anything that was too crazy. I would still live. I mean, I wouldn't spend. I'd spend some money, but I didn't buy expensive cars. I didn't go directly into an expensive house. I didn't do any of that. So that's what I did. And then eventually, your income, if you invest in dividend-paying stocks, they'll pay dividends over time. Your dividend income or your passive income will eventually um, replace your salary. And it does take some time. It's not fast. It's not like one year you save money and the next year all of a sudden you're just rich. It takes time, and in the beginning it's the hardest because the majority in the beginning is your savings contributions, less so from compounding. From Lynn's presentation at Bitcoin 2025, it says when the gap gets large enough, they have to print a bunch of money. They call it the big print. It is coming, and this is unstoppable, the debt Ponzi. So as your total debt continues to go up, if you get big, large gaps between your base money and the debt, they have to catch the gap back up. Right now, we are gapping again, and we're going to probably have to do another large print of money. Is there going to be a demand destruction event that gives them the excuse to print money? Maybe. That's totally possible. Or maybe they just print it. I don't know. That's the big question. Some people think, well, we'll get a recession, and then they just respond with money printing and stimulus. Well, that seems to be, they never let a good crisis go to waste, so they just print money and do stimulus. That's what 2020 is here in 2008. But even after 2008, they continue to print money pretty heavily. This money printing also coincides quite well with oil production too. As weird as that sounds. So this is the unstoppable train. Nothing stops this train, is what she says. And it deals with the design of the system. And if you can't stop the train and money keeps piling into the system in order for the system to survive, it's going to put pressure on commodities, especially those that have demand supply imbalances. Financial juice says JP Morgan CEO Diamond, you're going to see a crack in the bond market. And I'm sure that's with nothing can stop this train. They're both interconnected. Money keeps piling into the system. Nobody wants to buy bonds when your inflation rate is higher than the interest rate that's getting paid out. So that's the problem. The problem is, as you hit certain interest rates, you're actually stimulating the economy more, as the interest expense on the debt needs to be serviced through money printing. So it's almost like it's self-stimulating at some point when you increase interest rates. What it does is it slows down bank lending. So that's why we're seeing the real estate market slow down. So that they raise rates to slow down monetary bank lending. Problem is, when you increase interest rates, you get a stimulative effect from fiscal spending and the debt situation that we're in. So nothing can stop this train because of the debt situation. If interest rates go up to slow the monetary side, the fiscal side starts pumping money into the system through interest expense. And they can't stop it. It just keeps going and going and going. Joseph Brown says, wealth does not equal money. The opposite of poverty is wealth. Wealth equals the things that people want. To get things, they must be produced. The solution to poverty is production. And she's saying the solution to poverty is money. It's not money. That's why you got the Bank of Zimbabwe here. You know, I'm not even in the economic space, and I view this as like highly easy to figure out. This is not that difficult. When I look at the world, all we do is convert commodities to usable products through facilities using equipment and energy. The wealth is the things that people get to enjoy, whether it is a vacation, a house, or products that are built and made. That is the wealth. It's not money. Nobody wants money, so to speak. They want what money can buy. And if you have nothing that you can purchase with, but you have a lot of money, that's where you get the Bank of Zimbabwe, the inflation. That's where you get into the problems. It's people stealing from savers, or stealing purchasing power from the current money supply as they produce more and more, quote, money. So this whole thing, the system that we should build, should have a lot of blocks to it. Like you can't just print money out of nowhere. You should be able to produce and not have to have 8,000 regulations. And that's the end of a failing system, where the people who produce nothing control the production. They tell you, yes, you can produce, or no, you can't. They can also steal from the currency system. That's the end of an empire. They start to hyperinflate the currency. Eric Yoon says people are still confused as to how it all works. It's not rocket science. And this is about gold and silver. They have a gold and silver futures exchange called the COMEX. They have a gold and silver OTC promissory note market called the LBMA. They have gold and silver ETFs, GLD and SLV, etc. They link all these together with exchange for physical mechanism, which can be pure cash settlements or physical gold and silver deliveries. With all of this, they can flood the entire system with paper, discouraging actual physical gold and silver withdrawals by the plebs. They can also move the limited above ground physical gold and silver around to whichever part of the system that needs it. It is a diabolically ingenious system with many buffers and fail-safes. So this is what they did. I'll just sum it up in my view of it. They created a paper market to suppress the price of gold and silver because they could overwhelm the market with so much paper that they could basically bring the price down if they just threw paper at it. So if $100 billion comes to buy gold and silver, They could throw 500 billion of paper contracts to flood the market with supply of paper contracts to keep the price down. The way that they handle everything in the real system is they've got these paper catchers. They're called ETFs. GLD and SLV are just paper catchers. They catch paper looking for investment in gold and silver, but they don't have enough physical metal. So what they do is they have this pile of metal that they can circulate through the system to cover any shortfalls, either in the ETFs, the COMEX, the LBMA, or anywhere else that may have problems. So they catch the paper with paper where they can, and they've got a stockpile of metal that they can circulate through the system to slow down the demand for physical metal if that were to come up. And that's the whole system that we have. The physical metal will eventually go short for something like silver if you get incredible amounts of industrial demand. And you have a lot of industrial demand for platinum and palladium. So the piles of those are a lot smaller. In oil, you can't really do much with oil because they use it. You burn it and you use it in chemicals and paints and lubricants and all sorts of stuff, plastics. You convert it to usable products. It's much harder to do this game with some of the industrial materials. And these got a little diagram there. The Kobayashi letter says, breaking, JP Morgan CEO Jamie Dimon says he is quite prepared for rates to go to 5%. He also says the Fed is right to wait on rate cuts for now. Dimon is preparing for a 5% 10-year note yield. We've heard from Buffett that they want to try to get rates down. The rates going down helps the stock market and financial assets. Rates going up puts a headwind against financial assets and puts a tailwind behind precious metals and commodities. And that's part of money rotation. It deals with interest rates getting to a level of 5% or so, and maybe even higher. We could go way higher. It really depends on how much production we've got of oil. And it becomes a balancing act between nothing can stop this train and GDP, which is all linked to oil. Warren Buffett says a great investment opportunity occurs when a marvelous business encounters a one-time huge but solvable problem. One of the great companies that I was watching, Chipotle, they had a scare back in I think it was the 2010s, where they had a E. coli scare with some of their stuff. The stock sold way down, and it was a great opportunity to add more to it if you were able to. And I think it was a couple $100, maybe 300 or 250, somewhere in there. And then it went all the way to $1,250. The stock did. So yeah, that I think fits this quote quite well. In commodities, it's not commodities are different because the commodity price swings from overvalued to undervalued. It swings all over the place, and it also swings the commodity companies with it. So it's not a one-time huge solvable problem. They just go up and down because of the price of the commodity, and the price of the commodity determines everything about the business. It's return on equity, all the financial measures. So commodity companies are very volatile based off commodity prices. Baker Hughes rig count for 5:30 is oil's down 4 and gas is up 1. So the rig count is falling dramatically. And that will impact some of the energy service companies. It may already be priced in. So really what the pricing, when you look forward, it's what do people have in their models of where the rig count will go versus the actual rig count and how that transpires over time. It says, being a young millennial means being a 30-year-old that's seen the country degrade as much in their short lifetime as someone who is 2 or 3 times their age. Well, I mean, I don't think it's any different than before. 1940s, when everybody came back from war, we had a lot of spending going on. We went from 1940s all the way to 1980 in a large, increasing interest rate environment with good inflation for that entire time. So I think we're just switching from the 40-year decline of interest rates to an increase of interest rates. And that's what we're seeing and feeling. It's part of the cycle. What I would say is get educated on the cycle, learn these cycles, and benefit from them. Don't be a victim where you sit there and say, "Oh, it's degrading, it's so bad." Guys, you only have one life. You can sit there and complain about it, or you can do something about it. Figure out how you can take advantage of the system if we're in a certain market condition. Unusual Whale says, U.S. economy will be growing faster than 3% this time next year, predicts Treasury Besant. Well, I mean, they can manipulate the numbers to do that too. They can. But hopefully that's the case. Hopefully we get going by next year and it will be up faster than 3%. That'd be great for the investments that we are in. The Atlanta Fed model sees real GDP recovering to 3.8% for quarter two. This is what's out there. I don't make these predictions. I don't even really think they're worth anything, to be honest. But this is what people think. This is what's being shared. And I don't know. We'll see if it hits that. JSG says, compare bottom-up USA crude oil production versus the EIA for first quarter of 2025. The EIA quarter-over-quarter delta from a bottom-up approach suggests that the remaining 40% of market grew production. Not sure if this passes the sniff test. So the EIA, they keep releasing all this data. I don't even know how reliable it is. A lot of it gets revised lower later on, and I think they're incentivized to overstate production to try to get prices lower. They might be working with government to try to get some of these numbers overinflated for production and supply. So there is a gap between doing a bottoms-up approach where you look at the companies, you see what their production is, and then you see that it is down. And then you go look and see what the EIA says, and they're like, oh, your production's way up. And you're like, from where? Where is this huge production increase? It's not coming from the companies itself that you're stating these areas are producing from. Porter Stanbury says, extremely important where Lynn Alden says, nothing stops this train. I say, repeat after me, the spending will never stop. While she doesn't get into automatic COLA increases, the facts she lays out are the most important ones. Watch until the end. The highlight is her explaining of how paper money is an adjustable ledger. And we all know how they will continue to adjust it. If we watch anything carefully this weekend, this is it. And it says, Lynn Alden gave one of the clearest breakdowns of why the U.S. is on an unstoppable fiscal path and why Bitcoin matters more than ever because of it. So I agree with the first portion that we have to continue to spend in order for the system to survive. You can't shut it down and go into a deflationary problem. Then what people do is they say, with this situation that we are in, what are my potential investment vehicles? And why would I invest in some of those potential investment vehicles? In her opinion and in others' opinions, they like Bitcoin because they think that you can't increase the coin supply of Bitcoin. So they're like, well, this will go up in value. It's fantastic. Where I challenge is that everything in history that's man-made eventually goes to zero. All currencies, all businesses, everything. Bitcoin is man-made. Therefore, it will go to zero. It will have problems. there are flaws in the design. Gold and silver are elements that we find in nature. They're on the periodic chart. And we have found and discovered that those things work best for, say, using it as money, real money. So those have thousands of years of history, while Bitcoin is man-made and is new. And some people think that that's just going to go up to infinity, so to speak. I'm in the camp that eventually people are going to want to sell. Go back to the first quote. What is wealth? Wealth is production. It's production of goods and services that people want and need. If we get into a situation where people need to buy things, they have to buy something. They have to liquidate the stuff they don't need to buy the stuff that they do need. And to me, Bitcoin isn't something that you need. Silver is a requirement that people need for computers, cell phones, and all these other things. Gold, you could argue gold is more of just a measuring stick versus a money supply. But we use that as money for many, many years. Platinum and oil and all these other things, they all have uses. So can you eat Bitcoin? No, you can't eat gold either. And that you could say that Bitcoin potentially could have problems if you've got problems with your grid, or if certain things with technology progress to quantum computing and it starts to break the encryption and all this other stuff. There's a whole bunch of things that are bad. The miners don't get subsidized through the coins, so your transaction and processing fees go to astronomical levels. That's all part of the design of Bitcoin, which every design has flaws that is made by man. So there's my opinions. I would rather be in the things that people need versus the things that people want. I'd rather be in natural gas that heats your house that you basically need in order to survive than something that is more of a luxury that maybe people will liquidate and spend on the things that they do need. Another one from Porter Stanbury. He says, back in 2008 of April, I was alarmed by how expensive oil had become relative to real money, aka gold. You may not remember, but oil had spiked to above $100 per barrel, and Congress was investigating oil trading firms. I asked our lead quant analyst about it. He replied from an email dated 4/21/8. For the 20 years between 86 and 2006, the gold to oil ratio was below 8, only 3% of the time. During these periods, gold outperformed oil by 8.1% per year. During the other 97% of the time between 1986 and 2006, when the ratio was above 8, gold underperformed oil by 1%, i.e., oil was the more valuable commodity, but when it was so much more expensive compared to gold, it was time to buy gold. He's using ratios and swapping between ratios. Since 2008, we've moved from one extreme, oil vastly overvalued relative to gold, to the other extreme, where gold is vastly overvalued relative to oil. I have a feeling that over the next few years, a lot of people that own Bitcoin are going to wish they owned an oil field. I'm in that camp. Oil is going to be an incredible investment, and I agree with his assessment. Same with platinum. You just go around and you look at the undervalued assets, and then you acquire the undervalued assets, and then you just sit. It's a way to store wealth, and when these go to historical normal levels, or maybe they'll blow past normal and go to an overvalued state, it means that you just made a whole bunch of money. If you bought at an undervalued state and sold at an overvalued state. And this here, Mike McGlone says, oil versus gold is scary. The Great Depression deflation leanings. If crude oil doesn't rise versus gold from May levels, the end of 2025 would mark the highest gold to crude ratio ever. The global recession implications, last year low of 65 a barrel, may be WTI's ceiling. And I see risks leaning towards what's been normal since 2008. So he's going in there, he's thinking that we're going to get a crash. Well, here's my question. Nothing stops this train. Does he know what nothing stops this train means? If money keeps entering the system at a high rate, how are we going to get prices to go down? Some people say, oh, well, we're going to get a slowdown. I don't know. You're pumping the system with 7 to 8% of more money, or even maybe more than that, continually. 7, 7, 7, 8, 7, 9, 7, 7, 7, just keeps pumping in the system. That's inflation. Oil is very inflation sensitive. Now you're seeing the problem with the low calls. You're trying to make a call with the dollar declining, most likely. We got freight futures, AM update, dry bulk, Capesize and Panamax are up 1%, and tankers are flat for both VLCC and Suezmax. Here's another one from Grady. He says, silver miners are outperforming gold miners is one of my main characteristics of a large bull market in precious metals. I think it is time again for an epic move in silver miners. These opportunities are very, very rare, so do not miss it. And do play it right. You know what I've been buying? Silver miners. Silver junior miners, in fact. They are lagging behind GDX and GDXJ. He is 100% right using this ratio. If we do get a move coming up here, I think some of the stuff that we are in, which is already up a few 100%, are going to go up a lot more. And that's the importance of diversification in the system too. Some people try to market time things perfectly. So they put a lot of weighting in one individual sector, and that's where you get that volatility. And you better have a lot of conviction. But you can also spread across 4, 5, 6 different sectors, and you don't have to put everything in one sector. You might not make as much money as quickly, but what it does do is it protects you from downside. You also capture the asymmetric move to the upside. So a few sectors in the portfolio could be pulling the whole portfolio higher, while other sectors are consolidating or waiting. Then, when the conditions change a little bit, and it's hard to know exactly when those conditions change, and people try to use ratios to figure that out, you'll see an outperformance in the other sectors. So you might consolidate in the two that were outperforming, and then you've got 2, 3, 4, 5 that will outperform during a slightly different market condition. And then they just go back and forth, and then you get a more stabilized portfolio than you would saying going 100% into any one sector. And again, that's another one from Lynn Alden. This is the U.S. housing market. This is some data from Redfin. It says now has 500,000 more home sellers than home buyers. That's the most home buyers have outmatched home sellers in over a decade, according to Redfin. So this is going back to 2016, and the buyers are in the red and the sellers are in the blue. And you can see a potential mismatch here between sellers overpowering the buyers. What we should see then is an increase of inventory. And that's something that we should watch to see where that inventory goes and how high it goes. If we go to, say, 6 months, we are in a balanced market then. Then you can start getting bearish, in my opinion. Josh Young says, data centers' power demand is to be fulfilled by fossil fuels, says JP Morgan. There's a thing called physics. You can deny physics as much as you want, but you'll end up bankrupt. It doesn't come from the wall. So data center power demand is to be fulfilled by fossil fuels going out in the future. You can also see out in 2035 that coal is expected to increase substantially. Coal. Then we've got oil, coal. There's a whole bunch of things in here. Natural gas. This is gas peaker coming through there. Utility scale photovoltaics, offshore and onshore wind are up at the top there. 64% is fossil fuels. of the 100% of demand. This is leading economic indicators look at the future. Lagging economic indicators look at the past. So when we divide the leading index by the lagging index, we get a series that has fallen in 36 out of the last 40 months by order of magnitude of this decline. It is roughly akin to the 78 to 80 move. It is larger than the Gulf War 1991 and turn of the century recessions. It has not yet reached great financial crisis magnitude. It exceeded the COVID's decline well over a year ago. And this is how low we are, and we are incredibly low here. It looks like we're almost the lowest it's been outside of maybe 82, 83, which was the bottom of the stock market. So we're probably already in a recession here, and they're probably holding it down so they don't get inflation rocketing the system. If this starts to turn higher, it's going to convert it into inflation in the system. So that's why they're holding it down. This is the only way you can hold inflation down, is to hold the economy down while fiscal spending is so high. So they're trying to hold it down, and you basically have to put everybody into a recession if you're going to try to hold inflation down. You need to generate unemployment. And that's all I've got for today, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Use special as the coupon code. We've got a Sunday question and answer session coming up at 5 p.m. Mountain Time. All right, guys, that's all I've got. We'll catch you next time. This is Finding Value.